which takes us to our talk of the tape, how to navigate this pullback as tensions with Iran re-escalate and we await a monster SpaceX IPO coming up this week. Let's ask our panel. Requisite Capital's Bryn Talkington, Carson Group's Ryan Dietrich, and Woman in Trust, Megan Shu. Everyone here is a CNBC contributor. Great to have all three of you here. Ryan, if you don't mind, I'll start with you. You're saying a pullback, a consolidation, perfectly normal, but you believe this rally goes on into July. So is that what we're seeing here, just a regular run-of-the-mill pullback, or is something else happening?
Well, Frank, first off, thanks for having me back. I appreciate this. I mean, probably just run of the mill. I mean, let's just remember, it wasn't that long ago. We're talking about the S&P 500 up 9 weeks in a row. The S&P 500 up 9 days in a row, up almost 20% in 2 months. I mean, we've all heard the stats and the figures. The reality, though, Frank, that I'm encouraged by what we're seeing here. Look at the put-to-call ratios spikes that we've seen. We've seen a pretty good VIX spike on a relatively modest pullback in the markets. And the other thing, the rotation. And I know today industrial's getting hit pretty hard, but we've been seeing, yes, tech is obviously lagging. Yesterday, 368 stocks were up on the S&P 500, okay? We've been seeing actually more stocks above their 20-day moving average, 50-day moving average, and 200-day moving average the last 5 days, even though the market's down. So listen, it's not perfect, but I think this is still a healthy consolidation, or weakness, maybe consolidation, Frank.
All right. Megan, I want to come over to you. So are we definitely seeing a rotation? Like if you look at things like healthcare up about 4% over the last week or so, you're seeing staples actually moving higher, up over 3%. But at the same time, we have this IPO coming up at the end of the week, and there's a lot of talk about people who are selling tech just to have some cash on hand to buy this SpaceX IPO. I know healthcare, staples, and other parts of the market are benefiting, but are we truly seeing a rotation?
I think it's a little early to know if we're seeing a rotation or more of a broader risk-off trade. I would say that the catalysts for what we've experienced over the past couple of days can give us a little bit of reassurance that it is more of a rotation and not a broader sell-off. If you remember last week, the tech sector moved out of favor, starting with a little bit of a disappointing earnings result from Broadcom, and then much better economic data, which obviously led to higher interest rate expectations, which hit longer duration assets like technology. I think in the short term, the market would love to see Fed rate cuts, but in the longer term, the better economic data, I think, is what matters. And tech and the semiconductors and the whole AI investment play has been a place for investors to go with sluggish economic data. And now that that's starting to stabilize, maybe even pick up, I would expect to see a little bit of a rotation out of that. But on a longer term basis, technology is still attractive, still generated 3/4 of the earnings in the first quarter, and I think could be interesting tactically to add to dips here.
So, Megan, I want to talk to you about the idea that the market wants a rate cut. After today's CPI, highest read on headline in the last 3 years, doesn't that put that at the very minimum on the back burner, maybe not even happening in 2026?
Yeah, I think the market is right now pricing out Fed rate cuts. Our expectation is still that we could see 2 rate cuts this year. And I think the drivers of inflation are really important. Obviously, headline is being driven by higher energy prices, but the components of core are not picking up. So you're not seeing that higher energy trickle through into core. And as we think about shelter, core goods, as well as the impact of the consumer having negative real income, all of those 3 things point to disinflation as we move into the end of the year at the core level, which is really what matters to the Fed. The Fed raising rates is not going to do anything to curb energy prices, and I think they know that. So I think they will be more focused than ever on the core components of the CPI.
All right, Brent, I'm coming to you. Here on TV, we get really excited about things like a SpaceX IPO just because of the size of this company. And I think a lot of people are saying it's kind of looming over the market. It's kind of an overhang over the market, the fact that this is coming up on Friday. You said it's only partially true. So what part's true, and what's the other factor here we should be looking at?
Well, I think that you see the sell-off. First of all, this year's been, I think, anything but normal. We have this group of AI beneficiaries that have gone full hockey stick. So full parabolic, up and to the right. And so I think that what you're seeing right now is you're seeing some of that steam coming out of the pot on that. And so a lot of these stocks are technically now below their 21-day moving average. So from a momentum perspective, I think that is what you're seeing there is just, it was too steep, too fast. At the same time, you have this SpaceX IPO, which we're all excited about. But I think that people are overplaying their hand, saying the reason why this sell-off is happening, because all this money needs to be raised. I think it's a concentric circle, and that's part of it. But I think that really what you've seen, like with the GE Vernova, AMD, I can look at VRTS, a bunch of different stocks. They're all turning over at the same time. They're all now under their 21-day moving average. And so I think Friday we have this clearing event. And obviously, it's very hard to get too bearish because, number one, we have great earnings. We have this industrial revolution. And also, if Trump can pull off some type of ceasefire that goes into permanency, the markets are going to rip higher. And so I think you just have positioning around right now in technicals that are weak. And I think that these stocks being under the 21-day moving average, I think investors really need to take a close look at that because we could still see some weakness in those semi names while they're in that downward consolidation.
So, Brent, just kind of pulling on that theme, I know you're looking at the 21-day moving average. I was looking at our charts, the 50-day moving average for the Mag 7 and also for NVIDIA, just specifically as an individual stock. So are you saying this is a buying opportunity? Megan pointed out how much of their earnings are coming from the tech sector and specifically these 7 mega cap names. Is the fact that these are trading at a technical level and moving to the downside, but their earnings should still be intact, is that an opportunity or is that something you need to be careful of? Explain me the thesis.
Well, first of all, tech earnings actually this year are driven largely by NVIDIA and Micron. And so if you take those two stocks out of earnings, not only this quarter, but the rest of the year, the earnings growth from tech flattens out quite a bit. You're still getting a decent amount of growth. I think that you don't want to confuse short-term technicals with long-term earnings growth because really there's not that much correlation. And so I think the fundamentals of certain tech stocks are really strong, but I always respect the technicals. And when you have a momentum area like within these semis and they break that 10-21, you just want to understand where the 50-day is to see if that natural gravitational pull could be a better entry point versus in the middle of the 21 and 50-day.
Ron, I want to come back over to you. We were talking about the inflation print, headline highest read in 3 years. At the same time, you're saying you don't see any Fed cuts coming up this year, but you like 2 very cyclical sectors, financials and industrials, that directly benefit from rate cuts. If there's not going to be rate cuts, what's the thesis? Why those 2 sectors?
Yeah, it's what's priced in, what's not priced in. I think, Frank's best way to put this. Market's looking for a hike. I mean, that's what Fed fund futures are telling us. Today's inflation data, yeah, the core is a little bit weak, but we've been saying for a while at Carson Group, by the way, I'm at our headquarters in Omaha right now in our Nelly's upstairs on the 6th floor. And we've been saying inflation's broadening out all year, even before the war started. So we've been saying there's probably not going to be a rate cut. And we think now the Fed's probably simply on pause. And the other thing about inflation and rates and the economy's getting better, Frank. I mean, listen, the reality is it's getting better. And that wasn't really priced in when everybody was telling us there was a recession this time 2 months ago. And that's going to help those cyclical areas. We still like tech. I mean, let's not forget. We had a 6 Sigma event, okay, in what we saw in technology. Just so listeners know, that is supposed to happen once every 4 million years, okay, how much technology outperformed the last 50 days. To think that we weren't going to get some violent pullback, at least in technology growth momentum, was foolish. And now we're seeing it. But the other areas, and again, I think industrials, financials are probably going to be 2 that really benefit the second half this year as the economy comes back.
So, Megan, I want to come over to you. Again, you're seeing 2 rate cuts this year, but you're also seeing some market choppiness going into the summer and the year ends stronger. What creates all the choppiness that you're looking at? Is it the volatility from the SpaceX IPO? And I know Brent thinks we might be making too much of it. Is there some other factor that creates some of the choppiness?
Well, I think we've had a number of headwinds to the market since we started this year. It began with some slower economic data. It then moved into concerns around AI disruption to the labor market, other business models like software, and then we had the war. And the market has shrugged off a lot of that, continued to climb the so-called wall of worry. And I think a big part of that was 2 factors. One, earnings, which completely agree with Bryn in terms of some lopsidedness and some few companies that were really driving an outsized share of that. We also had tax refunds, which were 18% higher than last year. So that helped consumers to weather the increase in energy prices thus far. Now we're moving beyond earnings season. We are not getting more tax refunds. And obviously, as we saw from the headlines today, there's not really an end in sight to the war. So I'm not really expecting energy prices to move dramatically lower in the near term. So I think all of that just spells to kind of moving into more of a churn phase, having some of those tailwinds behind us. But then as we move into the latter half of the year, we do expect a little bit of easing from the Fed. The labor market is very encouraging. What we've seen from ISM manufacturing and services points to some underlying strength in the economy. So I think we get through this just fine, but we do need to take a breather. As you've heard from the rest of the panel, you can't accept 20 to 30% increases over a 2-month period and not also have to accept the 5 to 10% pullbacks. But I do think that those can be opportunities to add to the market, and we are staying fully invested here.
All right, Bryn, Ryan, Megan, great to hear from all three of you. Thank you again. You guys have a good day.